Good day and welcome to the Impact of COVID-19 on Vehicle Finance Companies, the Road Ahead conference call. Today's conference is being recorded. At this time, I would like to turn the conference over to Mohammed Rahan. Please go ahead, sir.
Thank you, Ellen. Good evening, everyone. Mohammed Irfan from Liquidity Capital here. Welcome to another session of Liquidity Capital's Impact 360 webinar series, where we bring to you an in-depth analysis of the impact of COVID-19 on different asset classes, and sector in focus today is commercial vehicle finance. CV finance as a sector is closely intertwined with the economy, both in terms of how it's a catalyst for driving a growing economy like ours, and also how it in turn gets impacted by macro events. The segment is not new to cyclical bouts and has its own share of ups and downs, with headwinds seen even in pre-COVID periods. Are CV companies looking at a downward trajectory, or have industry players started out their road to recovery? That's what we will discuss today. And of course, we will also be going into the learnings from all this. We are delighted to have with us two industry stalwarts, leading CV financiers, who will share with us the view on from ground and preparedness for the sector to deal with the situation. We are privileged to have Mr. Sachin Pillai with us. He is the MD and CEO of Hinduja Leyland Finance. Mr. Pillai has several years of experience in the field of financial services. He has led HLF in building the organization to become one of the leading players in the country and executing strategic plans relating to business development and market share. Prior to joining HLF, he was associated with Reliance Capital as Executive Vice President and Group Business Head and also with HDFC Bank Limited. Welcome, sir. It's my pleasure to introduce Mr. Rajan Sethia, a first-generation entrepreneur who started SK FinCorp in 1994. Again, SK is a leading player in the used CV space with a presence across 300 plus locations across Western and Northern India, with close to about 2 lakh customers. Mr. Sethia is on various industry bodies and the president of Rajasthan Finance Companies Association. Welcome, sir. So quickly moving on to the presentation. The format of the presentation today is we have divided it into 3 parts. We'll start off with a presentation from our guests, and then we'll have an interactive session before we move on to the question and answers from our participation for the last 20 minutes. Let me now request our first speaker, Mr. Sachin Pillai, to take us through his thoughts on Risk Aceas experience and, of course, outlook on the CV finance and market. Sir, we are keen to listen to your insights here, and over to you, and welcome again.
Thank you so much, Irfan, for the kind introduction and having me around on this webinar. Good evening to all participating on this webinar, and to my co-speaker, Mr. Rajendra Sethia, who also is a very good friend of mine. Pleasure, Sethia ji, to be proud of this platform with you today. As a start, thank you. As a start, I thought it will be good to set a perspective and background to this webinar, and we start off with a brief deck, which basically covers the movements on ground post the pandemic setting in, and of course the lockdown coming in after that, and effects as we feel it, as we are going through it right now, and what we feel would be the possible way forward, with a couple of likely scenarios which might emerge as we move ahead with this present situation. I will be largely restricting it to at the industry level, but as and when I feel some company-specific data would help me in bringing in more relevance to certain points, I'll be using that as well. So with that, Irfan, let's move on with the presentation. So basically, we are looking at, for COVID-19, having now playing out, what do we see as an outlook and what do we expect, in future, how things will play out. And obviously, we all know that prior to COVID-19 setting in itself, the vehicle industry, especially commercial vehicle, was going through a bit of a disruption. We've had seen a phase since November 18 when the industry was going through a downtrend in terms of a degrowth which had already set in. And on the backdrop of that is what, then we saw the COVID, scenario coming up, which kind of ended up with a lockdown coming in the last week of March, and then which was initially for mid of April, and then it got extended to early part of May, which further got extended to mid of May, and now we are looking at the fourth one, which is kind of on the verge of getting over. What we have seen during this period, in the first phase of the lockdown, the trucks on the road or the utilization was at a single digit, at 5 to 10% kind of utilization, which was there. Obviously, all the state borders, most of them were sealed off. There were hardly a bit of essential commodities getting transported, and most of the trucks also, because the lockdown got announced at we all know with a interval of around 4 hours. So there were a lot of trucks which got stranded across the country. The number was around 350,000 trucks which got stranded across the country. And post that, post the first phase getting over, we kind of saw a bit of a opening up happening from April 20th, and that is where we saw the utilization levels going up. Operators being able to get their trucks, on back in terms of, either at their offices across the country or getting it back. And, post May 3rd, post the, opening up happening after the second phase, we saw this utilization levels, inching towards 30-35%. And after May 17th, when the further opening up has happened, where green zones have got opened up, orange zone in a limited manner, and also red zones in a limited manner opening up happening. Essential commodities transportation has picked up, whereas still non-essential is still it's very, very limited. We have seen the utilization levels now kind of touching around 50-55%. And a lot of trucks now being kind of in the process of coming back into the on the roads. We do feel the way and whatever we are able to gather from the ground in terms of our customer engagement is to say that post the lifting of the lockdown, which possibly might be next week, we might see at least a 30 to 45 day period for trucks to be completely back on road. The trucks have been idle for a couple of months, so there is overhauling which is required. We have seen, the employees, that is the drivers, the cleaners, etc., possibly leaving back for their villages, etc. So getting them back there is a process involved. The en route after sales and the spares and that required infrastructure coming up would take some time. So all this we feel it's a 30 to 45 day period which will be involved, where the trucks would be back on the roads, and I will term it as normalcy, and then we'll see possibly another 90 days for the cash flows to stabilize. So here the scenario that we have looked at is that post June, that is when this lockdown kind of gets over, we might see a bit more of a opening up coming in terms of the movement. We have seen already trains and airlines, domestic airlines coming, starting off in the last few days. So expectation is that we might see the borders getting opened up and non-essential commodities also transportation happening. So this put together, we feel that from the present 50-55% kind of utilization, the industry would probably inch closer to around 75-80% in the next couple of months time. And then the required time cycle, time required for the cash flows to stabilize, another 90 days from there. So, roughly around September, October is where we feel, possibly we'll be inching towards a pre-COVID scenario in given the assumption that the opening up happens. The scenario 2 is to say that the opening up possibly will be a bit more delayed, and therefore, this period that we are looking at, September, October, might get postponed by another month or two, and therefore, to that extent, we will see collection efficiencies kind of taking, being a bit constrained, over another 2 months. In scenario 1, our expectation is that while the moratorium is on till August, post that we expect that by the end of the year we might see collections at the range of efficiencies at the range of around 85 to 90%. whereas in scenario 2, we see happening it a quarter later, that is in the first quarter of May 21, is where, we see this stability coming back. In line with that, if we look at how the gross NPAs should play out, we feel that in scenario 1, we might be looking at 150 to 200 bips of forming up happening as far as gross NPAs are concerned. Now here, we have not built in a scenario of post-August any other further forbearance coming in from the regulator in the form of either one window for restructuring loans or any relaxation in the NPA classification norms. If that comes in, then possibly these numbers might be looking a bit different. And in scenario 2, we feel that this the hardening might be in the range of around 300 bips or more if it kind of gets extended. So that's the outlook as we feel the pandemic playing out would have as far as commercial vehicle finance portfolios are concerned. Yeah, Irfan, you can go to the next slide. In terms of impact on CV finance, we kind of mapped it across, the geography of India, just to say that we looked at around 631 districts across the country, which, kind of covers around close to 3 lakh crores of AUM. And, what it kind of reflects is close to 44% of the principal outstanding is in, hotspot districts where the outbreak, it's having a large impact. And if you break down further, we have Maharashtra, which is having around close to 27,000 crores was in the 10 COVID hotspot districts. Tamil Nadu, which is having around close to 25,000 crores in 21 districts, which are hotspot. Andhra Pradesh around with close to 15,800 crores with around 11 districts, in the red hotspot categorization. So overall, these 3 states put together, the total POS of around 51.5% is where it's today in the hotspot districts as we speak right now. Yeah. So in terms of update from in the last 2 months or post the lockdown, as far as collection efficiencies are concerned, we have clearly seen while in the month of March, the lockdown happened around 23rd of March, which was almost like 80% of that month was kind of in normal zone, and the last 7-8 days is which got affected. And going forward in the month of April, while end of March, RBI did come up with the moratorium for March, April, and May, and most of the companies took at least 10 to 15 days for them to go to their board and get their moratorium policy approved. And as I had already mentioned, in terms of how the truck utilization levels were during this period, we saw collection efficiencies drop to somewhere between 15 to 30% across the industry. If I had to give a number as far as our own collection efficiencies in Hinduja Finance, it was around 40% for the month of April, and the trend as we speak right now in May continues to be on the same line. So we are expecting May to also having a 40% collection efficiencies to come in. In terms of on our overall customer base, we had around 75% of our customers opting for the moratorium, and 25% of the customers have not opted for the moratorium. So with 75% customers opting for moratorium, still getting a 40% kind of a collection efficiency coming in. Clearly, there are customers who have gone ahead opting for the moratorium, but after having understood the cost implications, which is what the ground team has been involved over the last 2 months in terms of getting in touch with the customers on their through their phone calls and kind of educating them in terms of what's the kind of impact which would happen with the moratorium being availed in terms of the higher interest cost, is where we have seen customers coming forth and paying their installments or part of their installments happening. So that's a positive sign which has kind of coming up. Secondly, while cash collections have been completely kind of, at a nil state post the lockdown because of the movements not being there, executives not able to reach out to the customers and then, going to the bank, etc. But there has been a definite push which we can see on the digital modes of, payment which the customers are now getting used to. And some data points around that. In our own case, our own app, customer app through which the customer can transact with us and pay his installments, which was launched somewhere in the last year. Till the month of March, it was a few thousand customers who have downloaded our app and very few of them who have transacted through it. But post May 23rd, we have seen this number as we speak right now risen to around 290,000 customers have downloaded the app, and many of them have started transacting through it, which means that over our overall customer base, we have achieved a penetration of around 32% as far as customers who have downloaded our app. And we are looking at possibly by mid of June, this number going up to 60-65%. So we have seen customers keen to download the app, go look at the digital way of moving forward, and also transacting through it. So that's been a positive as far as during this period is concerned. The extension of the moratorium, while it is, we had the second phase coming in right now in the last week. But what we feel is that with the business activity starting up, with the utilization levels going up, and also with the offices now opened up, we have almost close to around 185 of our branches which have got opened up in the green zones and partly in the orange zones. With the field level activity picking up, we should be seeing increased collection efficiencies happening where we reach out to the customers, and with their trucks back on road, with the cash flows coming in, they would logically would not like to have their interest cost going up, and therefore we will see increased collection efficiency despite the moratorium being in place, is what the sense that we get from the ground. Most of the large CV financiers, obviously, with moratorium being in play, and many of the banks still not have not come out clearly whether they will be extending the moratorium to NBFCs or not. So there is a mismatch which possibly is there in the system. But however, large CV financiers, we feel are in a should be in a comfortable position to tide over this in the next 3 to 6 months' time. In our own case, we have not availed the moratorium for April and May, and we have been making payments as per the original schedule. And most of the large CV financiers, we understand, are also in the same kind of thing. They are not availed the moratorium. Small regional players might have some amount of liquidity problems in terms of repaying their borrowings with lower collection efficiencies, and therefore will be keenly looking at availing the moratorium from banks and their other lenders. In terms of the challenges, as I had pointed out, March, we almost saw 80% of collection being achieved because post in the last 7 days, there was almost no activity on the field. Going forward, typically in CV collections, we see a lean season coming in with the rainfalls, which happens typically from the last end part of June till August. So that period, we still believe in the current scheme of things will be playing out. So we'll have that lean period, which is likely to happen. The demand for new CVs, as we see, one impact obviously which was there without COVID, without the COVID implication, what has been the technology transition, which from a BS6 to BS4 to BS6, it's happened as of April 1st. And in the process, what has happened is that on the technology side, we have seen a 2-notch enhancement coming in, which the industry has never seen in the past. And of course, with that, we have also seen the price increase which has come in. Now, in our understanding, even if COVID was not there, this period between April to August, all OEMs had looked at having a sluggish period as far as new CV sales is concerned, because with the technology change happening, most of the customers there will be a wait and watch to see how OEMs are getting it right as far as the technology is concerned, and also the price increase, how it gets kind of accepted at the customer level. So obviously, with COVID playing out, Q1 almost has been, at least in the month of April, there was no sales recorded. May, we are seeing some amount of movement coming in with OEMs who have their BS6 stock available, which is now getting moved to the dealers. So some amount of wholesale kind of push might come in as far as May is concerned, and we are getting some kind of green shoots that we are seeing in terms of customer leads generation happening, interest levels coming in. However, conversions are yet a bit far away. Of course, we have seen the All India Transport Welfare Association coming up with an advisory to the operators to stay away from purchase of new trucks in this financial year on account of the supply-demand mismatch. But in the past, what we have seen is that while this association is a mother of all other associations across the country, but normally the operators get largely influenced by their own association at the local level. The nodal association kind of messages we have not seen playing out on the ground. So we have to wait and see how this happens. In our assessment, we feel that the demand for MNHCV in this period will possibly come in through the more likely to we would see a forming up happening on the used commercial vehicle side. Obviously, the technology change as well as the price increase which is coming on account of that will be one of the major reasons why customers might look at used vehicles, looking at acquiring used vehicles for their requirements as the demand picks up, which means the existing BS3, BS4 vehicles, there might be a bit of a value appreciation which might happen. In terms of the customer behavior, obviously we feel that in this kind of challenging times, conserve cash would be the mantra from a customer standpoint. However, also at the same time, most of the customers, the commercial vehicle is the only source of their livelihood. So therefore, to the extent possible, they would like to service their loans and also have the vehicles with them for them to sustain through this period. So we also feel that would be one important factor as far as customer behavior in this period is concerned. With the lower economic activities, obviously, the supply-demand mismatch might continue. We feel that passenger-related vehicles might take a bit more longer time to recover as compared to goods, and the fact that many of the drivers, the cleaners, etc., have possibly gone back to their villages. So getting them back and getting them to operate the vehicles, that might be a bit of a time-taking process. That's what I had mentioned in the early slide, that 30 to 45 days we do foresee a time period for them to come back into normalcy and getting their vehicles back on road. So that is also one more factor which one needs to look at when the course correction happens for commercial vehicles to be back on the road. Yeah. So in terms of what should hold up and help us in the recovery, obviously, the way COVID has played out, and as we speak right now, the general feeling is that rural has remained largely unaffected. And during the same course, we had the Rabi crop, which was kind of record, Rabi crop, harvesting happening. So that's a bit of a good news during these chaotic times. And we have definitely seen in the month of May, our agri-related, we have a small tractor portfolio, and our agri-related tractor part, we have seen a good amount of throughput coming in terms of collections happening. So that's kind of an indication that rural is much better placed during this as compared to urban and semi-urban, as we speak. And therefore, the effect of that on the vehicle side, we certainly feel that the vehicles which are in the last mile connectivity in terms of the small commercial vehicles, three-wheelers, both on the goods and passenger side, even vehicles which will be linked to the intra-city and intra-state movement for essential commodities and non-essential commodities as it opens up, there will be a pent-up which needs to be demand on the ground which needs to be catered to, and therefore we might see a surge happening on that side as opening up happens. And certain numbers that OEMs have shared with us over the last 1 week to 10 days. For example, Hero was mentioning that over the first 3 to 4 days of the opening up of the green and orange locations, they have seen close to 10,000 bookings happening across the country, which is pretty heartening to note. Similarly, one of the largest three-wheeler manufacturers were mentioning that they already have leads of around 2,200 vehicles, largely on the rural side. One of the small commercial vehicle manufacturers was mentioning that they already dispatched around 650 vehicles across. They had a BS6 stock, and they have dispatched 650 vehicles across for various dealerships in the green and orange zone. So that also kind of gives an indication that there is a movement, and there is some green spots which are coming up right now, and possibly it will get formed up with the opening up happening, and we might see a gradual pickup coming in as far as the vehicles and the recovery is concerned on that side. With this background, if one has to look at how the default rates in the past have played out over the past 5 years, the PAR 90 numbers, we have seen an improvement both on the new and used CV side. PAR 90 for the new CVs have reduced from a peak of around 18% to 4%, while used CV it has reduced from 9 to 3%. The industry also did not see any material deterioration even the demonetization period, post that also. In FY18, the PAR numbers did not see a huge spike despite the economic disruption which was there. Now, this reflects a resilience of the industry towards downturns and ability to absorb temporary deterioration or temporary shocks in terms of which might have an impact on credit quality. It's even managed to get through a phase of 18% PAR 90 in new CV. So it kind of reflects the resilience of this the CV financiers of having the built-in buffers to take these shocks. And while in the current crisis or scheme of things, the magnitude are kind of unprecedented, and obviously we are going through the actual impact and looking at how things would evolve going forward. And since we don't have a precedence, we have to play it as it moves. But the general feeling is that since we have kind of absorbed shocks over the recent past and still sustained through, this also is a period that we would be able to do that. So this kind of reflects what I was saying, that as seen from the graphs out here, the major CV financing and BFCs have been able to consistently report profits, though the industry up-down cycles have happened over the past decade. CV typically is a cyclical product, and we have seen at least 4 to 5 downtrends which have happened over the last 2 decades. And during this period, we have seen the hardcore CV financing companies sustain through this period and also remain profitable. And GNPAs have obviously risen in the past on account of the A was the definition in NPA getting changed from 180 to 90. So at various stages, each of the NBFCs went through that cycle, and we had seen the NPAs picking up. But over a period, then we saw once the 90 coming in, and there was a stability which came in. Obviously, over the last 1 year, there has been a bit of a forming up being seen, which is reflected in terms of the way the underlying economic growth was there in the country pre-COVID, and that's something which got reflected in terms of the degrowth also, which happened since November 18. As we had already indicated that in FY20 there would be an increase in the PAR in the near term, but having been able to manage similar downtrends and similar kind of events in the past, we feel the commercial vehicle finance industries would be well in position to keep them in manageable proportions as it plays out. Just to give a global perspective to it, to look at how across the world the pool performances have been, and then to understand what possibly would be the impact on Indian market. The portfolio performance has worsened in both China and Europe in the last quarter. Chinese auto, asset-based securitization portfolios worsened, and the 30 to 60 DPD rose to an all-time high value of around 0.4 as of February 20. Prepayment rates have also fallen, indicating that the customers are holding on to cash available, cash conserve being the mantra. European auto ABSs have also reached the highest par 30 in the last 5 years, and asset performance trends has been worsening. And similarly, the pool performance in Indian markets has not also been different. It has taken a hit. Collection efficiencies of CV securitized pools were in the range of around 30 to 50% in April. Here also the pools which having higher SCV, LCV share have been performing better. In terms of support from the lenders, the flow of credit to CV finance companies in the past have been, we have looked at the data which is coming in from the MCA as a base, and as seen in the charts, the debt flow has been fluctuating in the past, along with the demand and performance of the industry, but it has not completely dried out ever, even during the downturns. It may be seen that even before COVID, the debt flow in FY20 was lower with reduced demand and lower disbursements. And as we go through this period right now, we have as we had mentioned, the large CV financiers are having access to banks, and also many of them have got the benefit of the TLTRO right now, which has got opened up, and in that also we have seen borrowings happening. So a combination of this should be kind of support which would come in from the lenders and to help the large CV financiers to move across through this period. Most of them not availing the moratorium, and while obviously the smaller ones might be looking at moratorium. Yeah. In terms of the liquidity and borrowing mix, we looked at instrument-wise borrowing, which has happened as on December 19. So basis the higher credit rating and diversified liability mix, the large players are expected to able to raise fresh borrowings even in the current market, and we are seeing that happening right now. Fortunately, post the ILFS scenario coming in, the reliance on commercial paper has kind of reduced for most of the large players. That has been a good one in terms of maintaining a better ALM. Along with the existing liquidity available, they should be able to keep their debt obligations and honor them despite weaker collections happening during this period. Players with a large share of non-term loan borrowings may not qualify for moratorium on the large part of the borrowing, so that's one more aspect which one needs to keep in mind. Smaller players will need more support in terms of moratorium availed and fresh borrowings to be raised. The other point is that securitization as a tool which most of the CV financiers have been able to look at in terms of most of the asset categories falling under priority sector direct agree norms. That as a tool for liquidity, at least in this period of moratorium, may not be there because most of the banks will wait for the moratorium period to end and see how collection efficiencies kind of play out before evincing interest for buying out portfolios. So that is something which also needs to be looked at in terms of how the liquidity and borrowing mix will play out during this period. In terms of key risk areas, obviously, as the economy opens up, as the trucks come back on road, the operators would look at loans to support this activity of getting the trucks back on road and going through the 90 to 120 day cycle for their cash flows to come back to stability. During that period, there will be a requirement from these customers to look at after the lockdown, and while financiers may not look at repossessing the vehicles or selling these vehicles in this market due to the uncertainty, and also from the operator's perspective, we feel that almost 65% of the industry consists of small road transport operators, first-time users, first-time buyers, for whom the asset right now is the sole source of livelihood for them, and therefore they may also not look at coming up a situation of their vehicles getting repossessed, and therefore we might see that also playing out. Fleet operators will face certain operational issues in terms of getting their drivers and cleaners and the infrastructure around that to be put in place, and that's what we said, it will take some time for the normalcy to come up. And obviously, the cash flow cycle getting stabilized is going to be one important aspect in terms of coming back to a pre-COVID kind of era. And there we feel that maybe the government might play a good role in terms of possibly clearing off the bills on this side, and that would possibly help the transportation segment overall in terms of coming back to normalcy as far as the cash flows are concerned. One has to wait and see how the corporate sector will be looking at in terms of paying off the transporters' bills. So that is something which one has to wait and see how it will evolve during this period. To summarize, increase in NPAs in the range of 150 to 200 bips is what we feel would play out. Obviously, during this period between April and August, with the moratorium being in place, we don't, there's no forming of NPAs which will come in. It also depends upon how the regulator looks at post-August, and if it kind of coincides with the recovery happening, and obviously post that we still have a period of around 2 to 3 months for the cash flows to stabilize for the commercial vehicle operators, and therefore if any forbearance, if at all it comes for that period, either in the form of one-time restructuring window coming in or in the form of some relaxation in the NPA norms classification, might have a comfort kind of a thing on this the way the hardening of NPAs is expected to happen on account of the COVID impact. With that not happening, with the 150 to 200 bits kind of NPA increase, we definitely feel the credit cost for CV financer companies might be, we're looking at an increase of around close to 75 to 100 bits over this period. Most of the players are likely to survive such a hit as seen from their resilience during the past industry downturns. So there will be some increased provisioning on account of stage 2 also, we feel, as we move forward. Collections efficiencies may also normalize to prior levels towards the end of FY21. And strength of most of the CV financiers have been their hold on collections, and they have proved in the past in terms of managing collection efficiencies even during difficult periods. On-field operations will gradually resume as the lockdown rules are relaxed, and cash collections will also gradually pick up. Here, possibly with lockdown getting opened up maybe in the next week or in the recent kind of future, we might see enhanced activity on the ground, and therefore, despite moratorium being there, we might see collection efficiencies picking up during this period. Overall, the sector has shown resilience through the down cycles in the past, and its performance will be very closely related to the overall economic activity. So that's something from my side, Irfan.
Thank you so much, sir. Thank you so much for this detailed presentation. And may I now request our guest speaker, Mr. Rajan Setia, to put out his thoughts on how you see the trends panning out on demand, collection, and also the cost, as well as your learnings and experience from the earlier crisis as well, and how are we prepared to tackle this in future. Sir, welcome, and welcome again, and over to you.
Thank you. So first of all, I would like to give my sincere thanks to Mr. Sachin. So he given us a overview of CV industry. So it will help for our further strategy also. And thank you, Irfan, and thank you everyone for joining this webinar today. So I here would like to cover largely on this small commercial vehicle, and especially in use, as we are in last 25 years in this business. And this year, last 3 months has been a very unprecedented event, and it has been once in a century event. So none of us were prepared for it, and but we're very resilient, and hopefully we will come out stronger. And we can see that the normalcy has started to return. And as Mr. Sachin also mentioned, this is good news in rural India. So only select pockets are impacted, and crop in this season is very supportive, and this is forecast of good monsoon, also boosting morale of borrowers for new purchasing and planning their funds. So little bit also I will mix of SK experience also. So we at SK, very thankfully, we moved and adopted digital as a way of doing business 2 years ago. And it has helped us in this slowdown track employees, business, do portfolio analytics, etc. And the customer segment and portfolio focus is going to remain the way it has been so far. And we are not making any structural or departures from our product or geography or strategy, because everything is supporting. And we also don't see any damage or any structural damage any of these segments where we are working. And we are absolutely 100% open for business in month of June. So further to that, to understand the overall business, so I would like to segregate in 3-4 parts. One is demand, other is collection, third one is your credit cost, and foremost important is in this time your liquidity. So in demand side, I can say this is your small commercial vehicle, and this is tractor. Largely we are in the used tractor and used car. So these will pick up very shortly. And used car, I think we will need to wait to watch. And long distance vehicles, I think will take little time, as already Siddhi mentioned in their things. And so on this collection, so I can say in collection, actually it's vary from company to company based on product mix. But economic activity is now picking up. So collection has improved, and from April in May, and we are expecting June better than from April and May. And because since economic activities for largely used vehicles seems to have improved, so this is what is there today. We expect things to get closer to normal and coming 30 days or maybe next 45 days. So and this is one more thing is supportive, like 90 to 95% of our employees are back to work, which helps in our collection efforts. And obviously, as per regulator, as per good president, and so that way they have all told the customers that unlike housing and MSME, we are being patient with collection, since if the customer has not driven his vehicle, he will not be able to generate income, and he will not be able to pay the installment. So we are cooperating him in a proper way. So to understand proper things, each and every customer is now observing in an individual way what is his position, what is his backup for paying installment, how many days he is running the vehicle. So these all things we are considering to support the customer. And yes, moratorium is right. Wherever he asks, we are providing. But in our case, moratorium percentage is approximately 50%. So half of the, we can say, our customer opted it. And this May month, we are till time, we have already collected 60% collection in this May month. Yes, April was slow. That month we done around 30%. And June, we are expecting better. So in credit cost, again, it will depending on product mix, and but we are providing extra provisioning. But unlike unsecured loans, people end up come back paying fastly, and but yes, normal credit cost will increase. That we also expect that spike will be. So right presently pre-COVID it was 100 bips for SK. That I'm talking about absolute credit loss. So that we're expecting to double 2% and maybe to 2.5%. But that is only purely based on provisioning. Because but I still very hopeful this will not fully translate to loss, this 250 bps additional provisioning, because customer, this secured loan, ultimately he pays. But yes, it will depend how this moratorium extended or the government things, as all things are already mentioned by Sachinji. So this thing will also will relate to your ultimate loss. And the other thing which I would like to mention, so the earlier problems like we see in demand, liquidity crunch, and this overall economy slowdown. So these all events actually helped us to fight this COVID situation, because in that time we learned too many things on collection, either to improving your collection infrastructure, proactive active collections. For industry. So here also I would like to mention on liquidity, because liquidity event also we seeing 2 years back. So that time usually in our company we used to maintain 5% liquidity, but now we were maintaining more than 15% liquidity in as a cash in account, and another 10 to 15% sanction one in hand. So these all learning came in during this time. So also we learned this is a debt equity. That time we used to have 6x type of things, but now we are maintaining 2.5, and also industry also moving in the same manner. So debt equity ratio is also now become very sensitive. So in this environment it is also helping. So so as we also very hydrate on equity part, so we are able to fight this situation little and great confidence. So moving this operational digital things also helped to stay business ready and address collection. So I think these all things, because sometimes that we say that things sometimes comes for new learning. So these last 2 years all crisis helped us now to control this situation also. So I am really very helpful to like to start business very fast, expecting in June. Yes, we are waiting for 31st May announcement of government, but we are ready. And collection, because your customer, wherever the orange zone and the green zones are there, vehicles are moving, and customer intent is very clear to pay, because this business of either it is vehicle or housing, these are very long back business. So 50-70 year business we are doing in our country. So their customer knows we have to pay, and now customer understood what is the moratorium. It is not ultimately any waiver. He has to pay, and he is now showing intent to pay. So this is from my side.
Thanks, sir. Again, very insightful. I think it was both the presentations were elaborate. What we can do, sir, given the paucity, is open up to our audience and participants for their Q&A. Eileen, if you could open the line, and then we can invite participants to pose their questions. And my request to participants is to introduce themselves and the organization when they present. And Also to limit, one query or question per head so that we can give others the chance. And of course, you can post your query online also so that we can get back to you and write back to you. Arvind, please open the line.
Thank you. If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on the phone line will indicate when your line is open. Please state your name before posing your question. Again, press *1 to ask a question. We will take our first question. Please go ahead.
Hi, this is Ramesh from Giant Capital. I would like to ask particularly SK and also general the vehicle finance sector. This new threat which is coming in from locust, how much of an impact will it have, and will it expand or will it increase further the time to take collections back above 90%? Thank you.
So this is a very relevant question. So this time locusts are entered in particular, this is state of Rajasthan, which is our mother state. But the supportive thing is this locust is now affecting on trees, not on these grounds due to heat. So impact is partially, but yes, we are keeping an eye on this, how it will impact, and the large impact will come. But till time as crop is not grown up, because already crop is cleared from this is farm. So presently it is hitting to trees and all, and due to hot weather, it is not impacting on the ground. But the threat will be after 2 months, maybe it is open, and it can impact up to some extent.
Yeah, that's a similar kind of feedback that we also got from our ground in terms of states of Rajasthan, Vidarbha, and MP, that it's come in between the Rabi harvest getting over and before the Kharif thing happens. So it's not having that kind of an impact, but one has to actually see how long it will remain and what kind of control will come in from the government side to look at any future impact from that side.
Thank you.
We will now take our next question. Please go ahead.
Hi, this is Anita from HSBC Asset Management. My question is on the bank's, ability or willingness to actually lend to the NBFC sector, particularly in the lower rated names. Because what we are seeing is across the banking sector, there is a huge amount of risk aversion. And even the TLTRO2 was not subscribed very well. So what is the sense in terms of banks giving support to NBFC sector as a whole, and particularly at the lower rated names?
So I think this question is for me. So as we are A-rated, so thank you, ma'am.
It's for the entire sector. I mean, it's not just for A-rated. Even AA-rated companies are actually having a challenge. Yeah. Just wanted to understand.
So, but I think no issue. So I am happy to share on this part. So all PSU banks are very supportive. Whatever allocation they are having, so every PSU bank have participated in this TLTRO, and they are sanctioned this limit, and they are working on this your partial credit facility also. So if I give you SK example, so right now we have sanction of 400 crore from PSU bank. So wherever we have applied, so they are yes, they check your previous record, they check your portfolio, what is and which product you are. If everything is fine, they have intent to like extend these facilities, and similarly, SIDBI also working in this way.
So where is actually the risk aversion then in the system? Because one banks are lending like 7 lakh crores in reverse repo. So where is actually the risk aversion then in the system with respect to PSU banks itself? Are they taking time, or like what is it that is the definition of risk aversion here?
So I think this is one thing is also I will also accept. So there the movement is slow because due to this operational challenge are hurdles, but I don't see any intent problem because rating from A onwards, every PSU bank already have exposure to this NBFC sector. Either it is from your own balance sheet or portfolio buyout. So they understand this business very well and supporting in a very, very large way. And because, yes, again, I would mention they would like to see what was your performance in previous time. If you don't have any baggage and your everything is clean, so they are very, very clearly coming out. Their treasury is assessing us and have sanctioned the limits without having any proper credit process system and all. So they are sanctioned. So it all things shows the things are only this operational challenge are hurting you.
Okay. All right. Yeah. Thank you.
Yeah, just to answer from my side, we did see. Hello.
Yes, sir.
Please go ahead, sir.
Yeah. No, I was saying that we did see after after even TLTRO 2 being there, we did see a credit aversion from banks, and that's something that we saw in terms of the reverse repo investments happening. But post that is in the last 2 weeks, we have seen a bit of opening up happening as far as banks are concerned. There is a kind of engagement which has picked up. Proposals are now moving through the various hierarchy. We also seen SIDBI and NABARD also proactively reaching out and looking at extending the credit facilities which has come through the various interventions by RBI and the Ministry of Finance. So we are seeing a firming up of interest levels which was absent in the first 1.5 months. Now we are seeing the tide turning around in the last 15 days, and I'm sure now the liquidity will start flowing into all the levels of company. Earlier it was only till in TLTRO 1 it was largely restricted to AAA rated companies. Now we are seeing the flow coming and with the below rated companies as well.
Hi, good evening. This is Nikhil from Norwest. My question to you, Sachin, is how does underwriting change going forward? Because what has happened in the past may not be applicable in the future. So how are you thinking about underwriting changes?
Yeah, quite obviously one would look at how customers have dealt with this challenge during this period in terms of I would say in general everybody would have gone for availing the moratorium, but despite that, what kind of was it more of a cash conserve that was the intent behind going for the moratorium, or it was a stretch in terms of cash not being there and therefore they are availing the moratorium is something we would like to assess when the fresh proposals start coming in. Obviously, the second one would be in terms of the area of operation where they are going to, and whether it is still affected by COVID or it is relatively unaffected, and that's the other point which would come in. And obviously, the third one obviously would be to look at the equity contribution coming in from the customer, the higher LTVs, etc., which possibly were in play pre-COVID. Might not be the way financiers would look at starting off. Once business resumes. So these are the changes that I feel will be broadly added on to the appraisal scorecards going forward as far as new business is going to come in the vehicle finance category.
Thanks. And do you see a significant contraction in the HCV segment because there is increased efficiency in the logistics segment today? And also there is some bit of contraction in demand overall in the economy. So do you see a significant contraction and TAM reducing over there?
You're saying in the heavy commercial vehicle segment?
Right.
Hello? Yeah. Yeah, it will, take some time for, I would say, in the overall vehicle trajectory, the heavy commercial vehicle segment possibly would be the, towards the end when we might see the pickup happening because of the factors that you mentioned. We would, very clearly, we might see the lower end, that is the last mile connectivity, the intra-city and intrastate movements picking up, and then, possibly the hub level transportations picking up, and therefore the demand getting reflected as far as the heavy commercial vehicle segment is concerned. And there also we feel that, the indications that are coming in used would be, possibly used commercial vehicles will be the first to pick up, and then followed by new MNHCVs. There again, the transition on technology and the price hike which has come in will be playing a role. So yeah, it will be a bit, in terms of as vehicle segment wise demand picking up, new heavy commercial vehicles might be, a bit later. We might see the pickup in demand happening.
All right. Thanks a lot.
Here there is a combined question.
Please go ahead.
Go ahead. I was referring to the question online again regarding the process with respect to the used vehicle. This is probably to Seshaji, in terms of the change in processes that are there in assessing the value of a vehicle and also the resale value of a used vehicle. Sir, you may want to throw some light on this.
Yeah, it's still evolving on that side. So, but clearly, as I mentioned, we might, come across a trend where we feel that the value of BS3, BS4 vehicles might be, kind of stable, or a bit of a firming up might happen in the resale values because on account of BS6, technology getting tested out and the price increase which is there, and therefore we feel that, used will be the category which will pick up. Having said that, NBFCs, financiers would, as I had mentioned, for the new vehicle category, look at a higher equity coming on the table from the customer side in this period as business resumes. A similar kind of thing which would happen as far as used is also concerned. So possibly in the past where 80-90% of the valuation amount was getting funded under used commercial vehicle, we might see that LTVs coming down and higher amount of, or expectation for a higher amount of margins to come in from the customers is how things will, at least to begin with, the norms would be looking at.
Hello.
Alim, you may take. Yeah, go ahead.
Yeah, hello, this is Ashwin from HSBC AMC. My question was, related to, how do you expect customer behavior once, this moratorium ends? Especially given the fact that, there's already a lot of oversupply and so on. Is it likely that there might be higher propensity to default because, or like at least even delay repayments simply because the customer also kind of knows that the financier may not gain much by kind of repossessing the vehicle at that point of time. Like kind of related question is to, like you said, used vehicle demand might be better, but in terms of prices and so on, wouldn't used vehicle prices also actually come down quite significantly, given this kind of scenario where like repossessions and so on? Please.
So look, as I said that, we feel in the past 2 months of period, that is between April and May, we have definitely seen utilization levels picking up, which was in single digit in the first phase of lockdown, now kind of, stay coming at around 50% plus. And with the within the expectation or assumption of lockdown getting lifted up in the next week or in the near future, we expect this utilization levels to go closer to 75-80%, and also state borders opening up and non-essential commodities getting transportation happening. So with that kind of a utilization levels, looking at the opening up happening and in maybe 2 months time happening, and that is where the moratorium gets over, definitely cash in hand for the customer would be higher than what they were having in the month of April, where utilization levels were at 5-10%. And as I was mentioning, our own collection efficiencies, if I look at, which was at 35 to 40% in April, and the same trend continuing in May, where the utilization levels were lower, and if I correlate it to higher utilization levels with higher cash in customers' hand, we definitely feel despite the moratorium being in place, the efficiencies should improve. And obviously, customers' initial reaction will always be to go for the moratorium. But when they see cash coming in, and when they already kind of have an understanding in terms of it's not a free lunch as far as moratorium is concerned, there is a higher interest cost attached to that. We do feel that going forward, our collection efficiencies should be improving. So I don't see, and also the fact that I had mentioned earlier that almost 65% of the truck owners across the country are small operators, are first-time users, first-time buyers. For them, this is a sole, income earning or livelihood, asset that they are having. They would definitely not like, in this kind of constrained economic conditions, for their livelihood asset to be taken off. So there will be, to our mind, enhanced intent for them, if the cash is there in their hands, for them to place it and and look at installment payments to happen. Referring to your used vehicle, as I had mentioned, we feel that the way it is going to play out, used commercial vehicle demand is possibly the first one to pick up, and therefore we might see the BS3, BS4 vehicles, the resale values to be we do foresee it would be possibly better than what we have seen in the pre-COVID era, and therefore that actually might play out in favor of financiers rather than the other way around. Is if at all that trend plays out, and that's the expectation that we feel it's going to happen.
Thank you, sir. So we'll take the last question for this webinar, and then we'll move towards. We are overshooting time. This is the last question. Thank you.
Please go ahead.
Yeah, good evening, Prashant from SBI Mutual Fund here. Just one question, sir. Basis talking to a lot of these trucking associations and a couple of logistic companies, sort of the average feedback is like 30-35% of trucking loans will default, and more towards banks, because apparently the LTV over there crosses 100%. What are your thoughts on this, sir? You think it will play out this way, or?
I missed your voice in between. Can you just repeat the question for me?
Yeah. So I was saying, just basis talking to some logistic companies and trucking associations, industry is saying like 30-35% default rate in truck loans, and more so towards the banks because the LTV crosses 100% there. Any thoughts on this, sir? You think it will play out this way, or?
I think it is more of a conjecture right now in terms of forecasting how this would happen, because we clearly the more
I think we lost the connection there. I think the view coming in from HLF, that was more around in two scenarios spreading across 150 to 200 basis points in scenario one, and probably greater than 300 basis points on NPA, and with respect to credit cost of about 75 to 125 basis points. That's a view.
Sure.
Thanks, Prashant.
Just one other question.
I think we are losing you, Prashant. Come again.
Hello. Yeah. Go ahead, sir. I think you were saying something.
No, we were not able to hear you. I was just telling the view of credit cost and NPA.
Yeah, fair enough. Just one last question, sir. I hope I can take that.
Yes, we'll take this, and then other participants can post the questions online, and we'll anyways revert to you on your queries.
Yeah. So, just a lot of people say that, the small transport operators, maybe less than 5 vehicles or something, they'll be very quick to restart versus somebody like a large fleet operator who will have to depend on a lot of factors. Do you think these things hold true?
Sajini, can I answer this question?
Sir, please go ahead.
Yeah. So these customers are, we call in technical language, this is first-time buyers and SRTOs. So these customers are actually not on a permanent project type of or contract they operate. So they operate like independent things. So they are not impacting cash flow on this segment because this is not depend upon any project or contract. So there is problem is less if you compare with the big transporters compared to the FTB and SRTOs. And one more thing is supporting. So there is no risk of migrant drivers because these customers largely owner and come driver of their vehicle. So this thing also helping to come out this situation.
Okay. Yeah, that's it from my side, sir. Thank you so much.
Yeah.
Thanks, everyone. I think it was actually an insightful session, and just to conclude, while there have been massive disruptions on account of COVID, very clearly the CV industry was earlier also facing headwinds even before the lockdown began. But the views around insights coming in on the NPA credit cost and field operations, our guest speakers have elaborated it very much. Many thanks to Mr. Sachin Pillai for the holistic presentation covering data, macro scenarios, field reports, and this definitely has helped us as well as our participants. Thank you, CTS sir, for discussing segment-wise behavior and throwing great insights on credit cost and loss that we could project on used CV segments. Right? Clearly, CV segment got into going into tough cycle, and bounce back requires significant efforts and time. However, the vintage of this segment has ensured that companies have gone through multiple cycles and have got fundamental sides. With these concluding remarks, I would like to thank everyone again, our guest speakers, for joining this webinar. Thanks everyone. Good day and stay safe.
Yeah. Thank you, Verti. Thank you, Irfan. Thank you, Sajini. Thank you, everyone. Bye-bye.
Thank you so much, Irfan.
Thank you, CTS sir.
Yeah.
This concludes today's call. Thank you for your participation. You may now disconnect.